Welcome to the Startup Espresso. I'm Hall T. Martin, the host of the show, where we talk about raising funding for your startup and the time it takes to have an espresso. I hope you enjoy this episode. Hello, this is Hall T. Martin with the Startup Funding Espresso, your daily shot of startup funding and investing. Secondaries stands for secondary sales, which refers to selling privately held stock in startups to other buyers. This arises from several sources, such as investors who want to get into the deal after the fundraise is complete, or employees who want to sell some of their shares. Secondary sales are on the rise since companies are staying private much longer. Investors often want to apply some of their startup capital into companies in the 3 years before an anticipated IPO, as investing in the first 3 years of the startup's life translates into a long holding time. There are many sources of secondary shares, including employees at companies doing well, websites that match investors to startups, and venture funds that focus on secondary sales. A secondary sale is different from a fundraise, as the latter involves issuing more stock, thus diluting the existing shareholders. A secondary sale is a transfer of ownership, and therefore there's no dilution to the current investors. Most secondary sales come with a 3-day lockup before reselling the shares. Thank you for joining us for the Startup Funding Espresso, where we help startups and investors connect for funding. Let's go start listening to today. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.